We are starting now with the next panel on on-chain asset management, running vaults and institutional generally having to understand how to manage those assets is becoming way more important over time. People want solutions that they can trust, and trust and security in running solutions like this is extremely important. Happy to introduce the panel and open the conversation.
Testing. Good. Okay, so thank you, Davide. My name is Giorgio. I've been in the industry for about 5 to 6 years. I now run a consulting firm called Vessel, where we do quantitative and strategic advisory for DeFi protocols. We've helped protocol scales in the order of dozens of millions, and yeah, been quite close to DeFi the whole time. So now I think it's good if the panelists introduce themselves. You can start from this side.
Hello, my name is Tobias. I've been in the industry for about 7 years. I'm co-founder of Altitude. Altitude is a loan optimizer on the Ethereum blockchain. And besides Altitude, I manage digital assets for clients where I get the most yield. I generate the most yield for them.
Hi everyone, I'm Matteo, CEO and co-founder of Orion Finance. We are building on-chain portfolio management infrastructure focused on basket products with an angle on institutional adoption, so privacy-preserving vaults on public blockchains, on-chain index methodologies, and potential permissioning for KYC and AML.
Good afternoon, everyone. I'm Francesco, or Biaff, as you prefer. I'm working at KPK, one of the leading asset manager in the space. We are doing basically everything from DAO treasury management to vault curation to our own proprietary fund. Happy to discuss with fellow minds.
My name is Darren Camas, co-founder CEO of IPOR Labs. We build Fusion, which is institutional vault stack.
Great, thank you all. So I think we can kick it off starting from 2020. We've seen decentralized finance evolve significantly, right, from that summer. We saw a shift from simple liquidity providing to more structured products, multi-strategy vaults, looping, tranching, you name it. What do you guys think is the single biggest hurdle for institutional grade asset management to scale on-chain as of today? Biaff, do you want to maybe kick it off?
Thank you. With the recent events, I think that most probably the biggest part to tackle is risk management, and in particular in the OPSEC. Today also Polymarket got hacked, and they saw that there was an EOA controlling a very important function within the protocol. So I also see that big institution cannot risk their reputation by joining a very interesting, new, talented project, but then being wrecked for these very minor or very basic minimal requirements.
Great. Darren, what do you think?
Yeah, I mean, we can take it from a couple different ways. So, you mentioned that you were helping people deploy since 2020, which is DeFi summer. That's the time we had fruit farms, yields were abundant, and it was very easy and very fun. And since then, actually, DeFi has gotten much more complicated and complex. So it's increasingly more difficult, even for very sophisticated power users, to actually interact with DeFi. And so that means that you need more and more tools for sophisticated traders. And I think then, on the other side, you asked about institutions. Institutions, actually, the number one blocker is the lack of KYC on the counterparty asset. I think that, many of the institutionals that I've talked with, one of the biggest blockers, especially if you're a regulated fund, is not knowing who your counterparty is. So I think there's a lot on the complexity, but also on the compliance side.
Interesting. Matteo, are you aligned on this, or?
Yeah, for sure, on both points. Maybe, I would like to double down on risk of ruin. Smart contract risk and cybersecurity is, it's not even justifying a 20% APY, arguably, for institutional managers that risk much more than just losing capital. Beside that, I would maybe add something about language barriers, I would say, between institutional managers. Like, it's not clear to us building in crypto which value chain we are substituting and enhancing, and vice versa. To institutional managers, it's difficult to understand our language. So I think this could be a barrier on top of the other ones.
Okay, interesting. That's the first time I hear that, actually. Now, shifting away from protocol level risk, I can give you mine once I ask the question, actually. Yeah. So shifting away from protocol level risk, something that is interesting is VIP lines, right? I think everybody that is active in the industry has heard of private deals, how LPs deploying 1 million, 5 million, 10 million, they could all get different terms. I see this as being a bit antithetical to DeFi, because that's not the ethos we all started this for. But I wanted to hear your thoughts in terms, do you guys think these are good for DeFi to mature, or are we taking a step back towards more traditional finance silos? Tobias, what do you think?
Yeah, so at the moment, I think half our portfolio is private deals, liquidity bootstrap deals. So I think what the market is telling us is that there's a demand for them. And I think the reason for the private deals, or why they work, why I think they're necessary for DeFi, is that when a brand new protocol launches a vault, and the vault is empty, then most users of DeFi will not put money into that vault because they don't trust it, because there's zero money in there. So how projects can overcome that is by working with people like us. We do the due diligence, we do the research, we do reference checks on the founders, we check out their legal structure, we check if they've audited everything properly. And that then gives us the confidence that even though a vault sits at $0, to put in the first 500K, put in the first million, and that then signals to the market that this is a vault that other people have trusted substantial amounts of money with. And so the other way to look at it is we do the work that then retail doesn't have to do, because retail sees a vault with 1, 2, 3, 4 million in there, feels comfortable, and then puts the money in there. And they kind of, in a way, they're benefiting from the work that we do on the due diligence side.
Very interesting. Okay, thank you. And Matteo, would you agree with that, or?
Yeah, let me take the subject from a different angle. You know, we are integrating privacy-preserving features into vaults which are built on Ethereum, so permissionless blockchains. We see this as a value, I would say, in line with the ethos of Ethereum. You know, I always like to say, you say don't trust, verify. You don't care about transparency per se, you care about transparency as a mean for verification. So I would say the ethos is about verifiability, and I think that privacy is not necessarily against it. We have the technology that keeps the two things together. And so I think there is room, I mean, there is need, you know. Crypto also came from the cypherpunk movement. So this tension between privacy and verifiability can be solved by the technology we have today, and should be, because IP is IP and should be protected.
Okay, great, thank you. Then maybe shifting from VIP deals, what do you guys think about RWAs? And how do they essentially fundamentally change the risk management requirements that you would have in a RWA-based product versus a crypto-native yield product? Maybe we can take this with Darren. So, Darren, you want to start?
Do you mind if I just go back and
you want to go on that?
I want to touch on the private deals.
You go.
From the other side.
We were the two one fighting back this question.
First from the builder's side, and then from, you know, like, so Fusion, we took a very hard approach, which was, just so you guys know, like when they're mentioning private deals are some things that, you know, someone with capital, they come and they say, okay, I want this guaranteed money on my assets, and I want you guys to underwrite my downside. And this has been a very common practice in the last 2 years. In the last 2 years, it's also been brutal for DeFi yields. It's been brutal for DeFi yields because of a brutal market. And you don't have a lot of capital that's actually exogenous capital that's entering DeFi. And so a lot of capital that's existing in DeFi has been able to cut these private deals. And in my view, they're cutting them at the expense of VCs that are investing in projects. And then projects are actually underwriting the risk out of their treasury for short-term capital rental at the expense of the long-term treasury. And if you are building a protocol or a startup, I think this is maybe one of the worst things that you can do, unless you get to that Lindy phase where you jump into the hundreds of millions or billions from this, and you're able to maintain the capital. Otherwise, it's a guaranteed route and a race to the bottom. And so this is something that, you know, it's been very difficult Hello, hello. Okay. It's been very difficult to go over, but this is one of the reasons that we've been laser focused on institutional capital. I'm a crypto and DeFi native through and through, but you know these deals go against actually the long-term building of my own protocol. So my greatest growth metric is actually turning people that have deposits in traditional bank accounts into DeFi users through seamless rails. So I'm not focused on growth and renting short-term capital. I actually want to get long-term sticky capital, but this is much more difficult to do, and this is why we didn't focus on the basically the private deals. And I think that state of the market is largely over.
Can I respond to that?
Yeah, sure.
I think it depends also on the definition of private deals. Because I think you're right. If a protocol is underwriting the risk, that's a very dangerous deal. The deals that I'm talking about is usually where we get additional yield or guaranteed allocation. We have done a few private deals on IPOR vaults where we get guaranteed allocation or a slightly higher yield just to kind of seed the vault. But I agree that the deals where you underwrite, where basically the protocol guarantees the losses, that's a very dangerous one.
Cool. Then maybe, Darren, if you want to move to the next question, what is the difference between RWA native yield versus crypto native yield, and what risk frameworks should we put in place to deal with this?
I mean, even relating to the private deals and actually the really dismal state of yields in DeFi in general, RWAs do something nice, which is give us a diversity of yields. So the reason that we're sitting sub-treasuries in lending in Aave is because we have lack of diversity. Everything is pegged to the crypto market, to volatility, to basically, I mean, 2020, 2021, you're borrowing from the credit markets actually because you want to speculate on Ethereum going up, right? After that, it becomes mostly a beta to Athena, which Athena is getting yield off of the volatility of Ethereum. Now that the markets are sideways and boring, all of that yield is dried up. So that's why we're sitting sub-treasury. So if you ask why would you ever take on the protocol risk to get subpar yields, it doesn't make sense, right? So the nice thing about RWAs and getting a diversity of yields on chain is that it'll actually create a more competitive rate market inside of DeFi.
Biaff, what do you think?
Well, I think that, I do agree with Darren. It's a good way to basically offer uncorrelated yield, even more in a moment like this. There are obviously, I have some concerns, or let's say pushback on full 100% coverage of only RWA's yield on chain, mainly because we know that behind these funds there are big names, and we may risk going back to trust assumptions instead of verifiability. One thing, we are also moving away from kind of yielding strategies, so staking, over-collateralized lending, looping that we know and that are genuine DeFi activities, toward more risky things that we don't know. And then from, let's say, a curation perspective, we have also more issues in monitoring such risk, because there is obviously an added value, so you're not picking a specific loan, but you're entering an index or anyway a basket of different loans, but these increase a lot the possible risk associated and the burden on the monitoring side, on our side. Having said that, I just received a message. We just launched one of our first RWA vault in partnership with Securitize. So things can happen, but obviously it calls for some adjustment from the curation standpoint, and we shouldn't just jump in blindly to say, okay, well, they're offering 9%, so no more ETH lending, but now USDC to BYWML. That's the point.
Yeah, makes sense. I think these institutions do constitute a great trust layer, right? If MBY is giving me 9 to 10%, or matter of fact, Goldman or, I don't know, Blackstone private credits fund, I would definitely deploy in that. So you think we shouldn't trust these institutions still? Like if you were to have access to Apollo RWA credit funds, you wouldn't just buy into it, like not blindly, but relatively doing less DD?
I mean, as a solo investor, obviously you can do whatever you want, luckily, but in our case, where we basically put our brand, our faces in front of the retail audience, and they do expect some level of professionalism from our side, so we cannot just jump in. Apollo, for example, yes, you are right, is a fantastic asset manager. I hope that KBK could only get 10% of that market size. But on the other hand, Acred has been jumping from negative to positive yields since the beginning of the year. So we decided basically to stop. It's there, it's whitelisted, we did our due diligence, but we cannot offer this to the retail audience that in some cases is even, has this sort of self-service entrance, so it can be even less aware of the risk involved. So it's a no-go for the time being.
Yeah,
okay.
I think it's also a bit problematic that in the time in TradFi when everyone's looking at the risk of private credit, DeFi users are looking to eat it up, and I think that tells you a little bit about the information asymmetry and maybe some of the lack of due diligence.
Yeah, you don't want to be the exit, liquidity for them.
100%. I mean, I think we could spend an hour just talking about private credits right now, right, in this market. But moving on from that, maybe, and talking about AI. So there's been a lot of startups that race to do agentic management, right, of funds on chain. I've not looked into it that much because I wouldn't want to give my funds to an AI manager as of now. But do you guys think that this is a necessity for Alpha to have AI managing your capital, or do you think it's more of a nothing burger and just marketing noise to use AI to manage? And maybe Tobias, if you want to start.
I think at the moment it's a good helper. So it's really it helps to make sense of a lot of data and kind of interpret that in some way. So it can give you signals, or it can give you ideas, or ideas where to look. So we use it a lot for due diligence, where it can really spot kind of details in certain documents that maybe because because if you can't spend too much time on it, you might have missed, and AI can help with that. I definitely wouldn't trust it at the moment to just manage money and move funds around on chain. What I do find helpful already is where it can start to kind of create the transactions for you. So you can tell it in natural language what you want to do, and maybe that results in 10, 15 transactions, and it can line them up for you. I haven't tested it yet. It's still a bit scary to me, but that's something I'm going to look into.
Matteo, what do you think?
Yeah, I think it's mainly hype. I would say that. I think it's very valuable, as you said, the stack from the prompt to model, let's say, to start to do some experimentation. I think AI, in the same way in which you don't see vibe-coded C++ code bases, you want some formal guarantees on the smart contracts. But even not on that, you don't want to use LLMs for, purely agentic asset management stuff. If the schema and let's say the action space of the agent is very limited, I think there is a lot of power. Having said all that, there is a lot of AI, which is, let's say, pre-OpenAI technology. So even just using shrinkage estimation for covariance risk measurement, it's valuable. That's something we do and we should all do. So that's AI. Let's call it machine learning, maybe, to distinguish it with agentic AI. So I think there is a lot of value there for asset management.
Okay, got it. So is anybody of you, is there somebody that would consider actually giving 5% of your portfolio to an AI agent that is managing your funds? Just yes or no? Anybody?
No, not at all.
What do you mean give?
Define manage.
You give, there are certain guardrails that the company that built it tell you they're in place, they cannot do things, and you check the code and it looks good to your team. Would you consider giving 5 to 10% of your portfolio to that infrastructure?
Again, it depends on what you mean by give, right? So for example, what kind of guardrails can you construct, and can you verify that this agent can do, right? How can it spend your money, right? So for example, if I hand you my wallet and say that you can spend it inside the Science Museum, I know that you can go get coffee or you can go to the gift shop. If I give you my wallet and you have free reign inside of Milan, it's a different thing. It's a different kind of risk scenario. If you can go out inside of all of Europe, it's a different beast. So if you can constrain the world, even at the smart contract level, this is what we do. Like, for example, if you think of Fusion as a box construct, it can limit, and for example, you can have a team that assigns what are the bounds, what are the markets, what are the assets, what is the slippage. And if the agent wants to do anything outside of that, it fails. So I wouldn't, but I just got off, we had an internal hackathon the last 3 days inside of IPOR Labs, actually building agentic tools for vault setup, for vault configuration, to actually spit out the asset management strategy. And at some point we'll get to agentic management, but it's more about what are the risk guarding. And I think as Tobias was saying, or Biaff also, you can use AI actually to do a great risk breakdown of a vault strategy or of an asset management strategy, because you can see all of the smart contract dependencies. So I think it's much better on the risk management side to spot, but I would go the other way.
Yeah, it's more on the operational side, you see. So risk management or transaction setup, these kind of things. But for the alpha, is still not yet ready. I mean, there are some protocols, AI managed, let's say, that are integrating our vaults, but I don't really see the added value. So basically, we are integrating already well-optimized vaults, and okay, probably we are further optimizing, but where's the alpha? So, and then probably you are taking a fee out of it, so probably you are killing it. So, not yet there.
Yeah, got it. Okay, cool. Then maybe moving on from AI, let's talk about quantifying risk. There's a lot of protocols that manage funds actively, right? I mean, for me, Avant is the first that comes to mind, where they're deploying across a subset of different protocols. We also had the, Kelp DAO and have a issue that I'm sure some of you have followed here, right? Now, how do you think we can actually quantify value at risk when a protocol is shifting funds from protocol to protocol to protocol? How can we do that? Do you want to take that, Matteo?
Yeah, so maybe again on AI, the value of AI can shine there. Like we've been looking at Orion at how to understand smart contract risk from the perspective of industry segmentation, if you will, at the level of smart contract dependencies. So, risk, I think it comes from rebuilding a factor decomposition of risk, and I think there is a lot of value in using smart contract topology to infer some kind of programmatic categorization of risk. We'll be looking at this not for the Kelp DAO, but for the Resolve hack propagated into some of the metamorpho vaults. You can see a lot from just the contamination risk. You can do a lot with AI on understanding contamination risk and kind of be industry neutral. I like to use industry to be related to the, let's say, MSCI multi-factor model approach. Yeah, I think there's a lot of value in rebuilding these frameworks for understanding risk from the perspective of the topology of smart contracts.
Okay, got it. Biaff, what do you think? Would you agree?
Oh, well, risk is a very broad spectrum, but trying to answer your question, I do think that is part of the fantastic design of DeFi, that we are basically speaking about a continuous environment, a continuous finance environment. So the moment, I mean, for example, in our case, for example, we are starting to trust a lot third-party ratings, for example, with the Credora guys. And I do think that the moment Credora will be able to offer 100% uptime, and on our side, we will be able to really integrate these processes, then we can really achieve something that is probably harder in traditional finance, because basically we can keep on adjusting our exposure depending conditional to the risk rating of the collateral that is connected to all the dependencies in real time, basically. And this is something fantastic, because there shouldn't be real human intervention. So I'm not speaking about AI, I'm speaking about smart contracts automation that basically if this, then that, so keep on adjusting and improving on one side the yield offered, but on the other side also the risk exposure for the end client.
Okay, great. I agree. I think WebAssy is also doing something like this where they iterate on risks, like they actually do risk framework, right? So that's a great product that's going to come more and more. Moving on from this, because we're running a little bit short of time. I think this is interesting. Something that I've seen in DeFi, right, as yields are compressing more and more, is the rates going sub the interest-free rate, right? So we're seeing vaults where you can deploy and actually get 2 or 3%, and you're on your stable coins, and you actually take both the protocol level risk and also the USDC or USDT risks, right? That we're not pricing at 0%, in my opinion. So why do you think that is? Tobias, maybe you want to start on this one.
So I think a lot of capital on chain doesn't immediately move when the rates change. So not everybody watches their position continuously. So just because there's a few hundred million in a pool that does 2-3% doesn't mean that they've actively chosen to deploy there. Maybe they're just a bit kind of lazy to move their funds, right? And I think the other thing is people don't necessarily want to off ramp and then on ramp again, because you lose about 1% when you do that. So yeah, and tax in certain countries, most countries. So I think that's a little bit, that's the two things I think are the reason that there's still funds there, the inertia of people just not moving their funds around, and people wanting to keep their funds on chain. But yeah, you shouldn't put money in a pool that does 2-3%. That's stupid.
Yeah. Darren, what do you think?
Yeah, I mean, we have the lack of diversity. I think RWAs will change some of this. Also, the interest rate models are quite basic inside of DeFi. You have this basic utilization curve. Sometimes the people that are adjusting them are asleep at the wheel. Like, for example, when the TradFi interest rates were at 0, DeFi was eating, and then those rates completely inverted, and the treasuries went to 5%, and DeFi yields went to sub 1. And I mean, that it obviously doesn't make sense, but some of the mechanisms that we have in DeFi are quite primitive, and we actually started as an interest rate derivative protocol, and it was probably about 5 years too early, ahead of its time, because we believed that market efficiency would come. In the end, it didn't. So we actually built a market efficiency engine. But now, actually, you see a lot of interesting experiments in DeFi that were also, 5 years ago. This is, I think, the second wave. A lot of fixed rate protocols are coming out. A lot of people are trying to do interest rate derivatives, which is actually IPOR's core. So I think that will shake up the market landscape. And by shaking up the market landscape, it will bring back some arbitrage opportunities for savvy traders. And
then probably Matteo is, Giorgio, is also a matter of going back, to DeFi ethos, because we got 500K, or not, if not even more, in a 2% super safe vault. But I mean, from time to time, it's I don't know if it is political or, but anyway, your stance is I'm staying with DeFi for plenty of diversification, immutability, verifiability, although it's not always the case, instead of going back to the traditional market who stabbed me already sometimes. So it's true that now the yields are compressed, so it's also a good occasion, a good opportunity to look for something else. But on the other side, I'm also glad to see that people are also saying, okay, well, now is a moment of calm water, so we should just basically accept that this is the yield I can get if I want to stay in a low-risk area. And then maybe in the future we will have a more bullish moment and we can go back, not probably to the 32 yield that we were seeing back in the summer, but to probably a double-digit return. But I mean, users should also adjust, something that we weren't seeing before. So before it was, okay, this one is no more yielding 22%, I'm moving to the next one to 28%, without even bothering about risk and all the implication related to that APY.
I agree, and I think it makes a lot of sense that users are staying in DeFi because they don't want to move out, right? And maybe they take the 3% knowing that they're going to find a better opportunity in the near term. Okay, so shifting away from this, I think I want to talk about token incentives. Going back again to DeFi summer, I think a lot of us have heard of a protocol called PancakeSwap, and now PancakeSwap was incentivizing liquidity provision with Cake, right? And that was massive because Cake was just mooning, right? Started at 20 cents, it went to $20 in what, 4 months? And people were just farming it, it was going up and up and up, right? And we weren't selling because, you know, it's going up. We saw that moving to pre-TG token incentives, meaning tokens that have a fictional value, not a real value on the market, but this worked well over 2024 and 2025 to steal or points campaigns or whatever, right? Do you guys think that these liquidity bootstrapping deals that have these tokens, right? Maybe they generate 12% APY and then another 10% or 15% in tokens. Are these seen as a good sign, or maybe they symbolize a weak product at the basis? Tobias, what do you think?
I think token incentives are a great way to incentivize early usage. So if you think about it, let's say you would fork Aave and you would launch Aave v3, right? How do you compete with them? If you offer the same rate, if you're able to offer the same rate as Aave, then obviously it's rational to put your money with Aave, not with a new protocol. And so I think doing a points campaign where you're very clear in how it will translate into the token, I think it's a wonderful mechanism for early stage protocols to incentivize usage. I think it really aligns.
Great. Matteo, what do you think?
Yeah, I think the points system has been very interesting to look at. I think in general it's very good to have I mean, maybe this relates to the point that we discussed before on liquidity bootstrapping. I think it's a very healthier system, more sustainable, and I think it's aligning the incentives a bit more longer term, even though it's still an incentive program that can fight back. That's it.
I'm fully aligned with Tobias. I mean, we are seeing also in the traditional markets, you have this kind of migration gift if you're moving from Vodafone to another mobile service. So it makes completely sense. I'm also glad to see that nowadays there are some more mature users that can also, okay, well, I'm happy if I'm receiving something on top, but it's not that I need that 50% more in incentives. So probably, I mean, but I don't know. I'm also happy to collect your feedback. Option one is basically they matured, so they see, okay, I should trust the real staking yield or the over-collateralized lending yield, and then the other things are an extra. Good to have, but not mandatory. Or on the other side, we just basically write off any extra incentives saying, okay, but it will be worthless, either I will just dump it the moment they make it transferable, so I'm not even bothering myself in running to try to sell out, and I will just not consider these extra tokens.
Yes. Darren?
Yeah, I mean, I actually really like token incentives in general as a good bootstrapping mechanism. I like the liquidity mining because it's extremely transparent. I dislike points, but I have a points program. So take that as you will. But I mean, it's really about design, right? Again, like if you think from the entrepreneurship perspective, you want to incentivize to create long-term value alignment. This is the most important thing to be. So this is why, yeah, I mean, it's long-term value alignment and incentive.
Okay, great. Okay, guys, we're 5 minutes. We just have 5 minutes now. I think we can end it with a lightning question and maybe take 20 seconds to think about it if you have to. In just 1 word or maximum 3 words, what do you think is the single greatest threat to basically on-chain yields and DeFi as a whole? Who wants to start?
I think it's irrelevance. So earlier this week I was in London. There was a very institutional conference. Lots of lawyers, lots of big banks, lots of regulators, talking about how they want to tokenize everything and how it's amazing, how 24/7 trading, and how they love kind of tokenized assets. They also said they don't want fragmentation. So I think where we are now with Ethereum having most of the liquidity, I think it's a very appealing place for them to interact with. I think the more, if the liquidity compared to what they can do on their own chains starts to drop, then kind of DeFi becomes irrelevant, because TradFi moves away, most of the money moves away, and then what's left?
Okay, interesting take. What, you want to go?
Risk of ruin are the three words I've been thinking about. And yeah, I mean, smart contract risk, ops risk, post-Mythos days have been harsh, not just in DeFi, by the way. GitHub, Vercel, NPM. Yeah, I mean, NPM everywhere. Yeah, there's been a few big ones, not in DeFi. And DeFi correlates 100% with this increase in cybersecurity risks. And it's also much more dangerous to feel that for us. So that's, I would say, the biggest blocker we need to fight back against.
Yeah, I agree. I think operational security is something that scares me so much. Like, I think one day we might wake up and just like Morpho and Aave have been breached for like 10 billion, and we're all just crumbling around like it's 2022 with Terra Luna again, right? But okay, Biaff, what do you think? What is the single greatest risk?
I go with true, Lazarus Group. Today there was a very interesting speech here on this stage, where they basically saying that 7 years ago the focus on DeFi X was just 10% related to Lazarus, while now it's 70%. So they are basically understand that, okay, we can steal there a lot of money and there is room for improvement from their point of view. So yes, I'm aligned with your view, Matteo, that yeah, we should try to improve that. One interesting thing that we were discussing yesterday night is that basically is still economically more interesting for a bad actor to basically steal these instead of just operate in a positive way. Something that Ethereum was able to instead block, because now you need basically more than 57 billion to take the 51% of the staking control of Ethereum, and it doesn't make sense economically. On the other side, instead, they still, I mean, makes a lot of sense, because, again, in that presentation, they say, yeah, it took 6 months of IRL interaction to then steal 300 million. So I think that from an economics perspective, it was probably a good investment.
Darren, what do you think?
Yeah, Lazarus, OPSEC, and AI hacking.
Yeah. Okay, so I think we're mostly aligned here. But I like Tobias' answer, a little bit more controversial on the irrelevance. Okay, cool, guys. I think this is all. It's 6 p.m. sharp. So thank you all for participating in the panel. Thank you all for listening, and we'll see you next year.
Thank you, guys.
Thank you for having us.